Hello, my name is Ewan McGahey, and in Enterprise Law today we are doing banking. So the concept I'd like to begin with is the well-known phrase that the love of money is the root of all evil, or in Latin, radix malorum est cupiditas. And this comes from the Bible, but it is also popularised as a phrase by Chaucer's character, the Pardoner, in the Pardoner's Tales, part of the Canterbury Tales, shortly after the Black Death. In 1389. But whether or not the love of money is the root of all evil, money is certainly the root of much enterprise. And of course, banks play the major role in issuing primarily debt finance to other enterprises across the board. So banks are really central to the way that an economy runs. Like them or not, they are an essential part of ensuring that people have access to finance, credit, in order to be able to build, create, and innovate. But there are some major issues of contest in the way that banks operate. First, whose interest should a central bank pursue? And we might broaden that to ask, whose interest should private banks should be acting in where there are private banks. Secondly, although in most countries there are private banks, the majority, in most wealthy developed countries there are also public option banks, both retail and investment banks. So the second question is, should there be public option banks too? Thirdly, what about the governance of banks? So should there be customer and staff voice in the way that banks operate, selecting people who are on the board of directors? And fourthly, what should be the safeguards for depositors and customers who leave their money or rely in banks or rely on banking services? So we're going to run through the history, looking also, as we usually do, the human rights involved in banking and the market failures at play. Secondly, we're going to look at the finance of the banking sector, if you like, the finance of finance for central banks, their monetary policy, rules on insolvency, and so forth. Thirdly, we're going to look at governance. We're going to look at the governance of the central banks themselves and also private banks. Basic questions of who controls the City of London, who controls Wall Street and other financial centres like Frankfurt, Hong Kong, Singapore, Shanghai, Tokyo, all around the world. And fourthly, what rights are there in banking law that are specifically enforceable in court for the main users of the service? And in this case, it's usually depositors. Now, before we get into the history, it's worth looking at how technology has shifted in relation to banking over the years. And fundamentally, the business is the same. What banks do is they take savings from people and they put them out to make them available for investment through loans or through debt capital. But there have been pretty major shifts in the way that banks have been seen and been regulated and the access of technology that bankers had. So we go back into the Middle Ages or the ancient times. Everything has been done by pen and paper, or it's being physically recorded. Banks were highly restricted. There were bans on usury. And so it wasn't really until, as we're going to see, the Renaissance that banking began to flourish, or at least expand its reach across Europe. So it developed through bills of exchange, which were credit notes. And these were negotiable instruments that allowed the bearer to transfer the IOU to whoever had the bill of exchange. So these were really important in the story of the development of credit. But really not much in technological terms until you get to the 20th century and you get electronic computing and data storage. So the automatic teller machine, the ATM, is seen as one of the most important and convenient innovations for users. And in fact, in the global financial crisis of 2007, 2008, Paul Volcker famously said that the finance sector hadn't really had any innovation at all before or since the ATM. But now we know that, we can see it on our phones. The innovation is taking place apace because we've got new fintech apps. We've got companies that specialize in financial technology, which essentially increases the scope and the rapidity that banking services, monetary transactions, monetary payments can be made. So in the 21st century, the real difference to the 20th century or the 19th century and before is the scale and the scope and the speed at which financial transactions can take place. But still, the fundamentals of banking are really the same. The banks take savings and they channel them, hopefully as efficiently as possible, into investment, mainly by way of loans. So let's dive into the history. As I mentioned, when we go back to biblical times, what we can see is that banking is severely restricted. Nothing like modern banking as we know it. We look at the Old Testament and in Exodus, loans are forbidden, which carry interest if loans are made to the poor. Deuteronomy says that the Israelites can charge interest to foreigners, but not to Israelites themselves, not to their own community, only to outsiders. And in John, in the New Testament, we see that one time that Jesus Christ really gets angry is that he whips the money lenders, the money changers in the temple and casts them out. And so this is all added up in Christian theology to, well, several things. First of all, as expanded by Thomas Aquinas in Summa Theologica, that usury is sinful, and what usury means, it's just really a pejorative word for charging interest. You can't do it. But then, quite conveniently, it was thought in Christian doctrine that Jewish people could lend money, could charge interest. And this was one of the pretexts for allowing Jewish communities within the Christian empires of medieval Europe to live and trade, but also lend money. At the same time, Jewish people were, based on the sort of warping of the Bible, seen as inherently suspicious, inherently sinful. And so right throughout the history of Europe, you see Jewish people subjected to pogroms, expulsion, they're put into ghettos, and although people in the Christian community rely on their services because Christians are not meant to charge interest, but Jewish people can, they're subject to regular persecution. So just one example is the Jewish Edict of Expulsion in 1290 in England. So there's an incredibly complicated relationship, to say the least, between religion and debt and banking. Even further complicated, another example, is the Knights Templar, the famous order which was part of the Crusades in the so-called Holy Land, a bloodthirsty series of wars, of course, from the 1000s onwards for centuries. And the Knights Templar was one of the orders of knights, but not only were they crusaders and fighters, they were also they had a network to set up the intercontinental transfer of money and loans. And because they became very successful at banking through their networks, they became one of the chief bankers to King Philip IV in France. He became very indebted to them, and that was their downfall because the Knights Templar had given so much credit to King Philip, he decided that it would be much easier to kill them all and round them up and destroy the Knights Templar rather than repay his loans. And so that's precisely what happened in 1312. There's not really any real mystery about this, although plenty of authors have written about this in things like the Da Vinci Code and so on. Okay, so there's this complicated history between religion and, I suppose we can add, political power and debt. And within Christian theology, there's no doubt that it is sinful to make money. And also, in a related way, we have Chaucer's character of the pardoner who goes a step further and is selling people pardons to get into heaven. And so, here you have an example of the perception that the use of money in religion is inherently corrupt, and that's precisely what Chaucer represents about this evil character of the pardoner. We'll get back to that in just a minute. But so, banking does not really exist, given the destruction of the Knights Templar in modern form that we have today until the Renaissance period. To cut a very long story short, you had the Black Death in the mid-1300s, and after the Black Death, you have the expansion of movement and trade around Europe, and with these trade fairs that start popping up because people have cast off their landlords, people are temporarily a little bit more free, serfdom is breaking down rapidly in England, a little bit also elsewhere in continental Europe. Because of these trade fairs, you have the development of banking networks in roughly the same way Knights Templar was doing, but so the setting up of networks. And when you have different currencies between, say, Italy and France or parts of Germany, then what you need to do is some form of currency exchange. So what the early bankers did, and the best one, or the one that won the competition, was the Medici Bank in Florence. What the best ones figured out that they could do is that when they made foreign exchange transactions, they could charge a commission on the exchange. And so, it could be effectively the same as giving somebody a loan. You take promise to pay in one currency and then you pay in another currency, and the commission for the foreign exchange can effectively function as an interest rate without being directly an interest rate on paper. And so that's precisely how the early banks got to do interest rates without it looking, in substance, it was charging interest without it looking like interest, and getting around the religious prohibitions on usury. And this was very successful. The Medicis were rubbing shoulders with people in Florence who ended up becoming popes. So Giovanni de' Medici, the first successful Medici, was a big friend of the person who became Pope John in 1410, or one of the Johns. And before long, Giovanni had a son, and his son had a son, and this son became Pope Leo X in 1513. So you have this pretty straightforward translation between banking power and political power. And of course, back then, the church was one of the preeminent political authorities, as well as being religious. So the bankers take over, in effect, the Catholic Church in 1513. And, being people of money, what they decide to do is build an enormous cathedral, more spectacular than anything ever seen before, by rebuilding St. Peter's. And in order to raise money to do this, think back now to the pardoner, they sell huge numbers of indulgences. So these are essentially passports for the rich to get rid of their sins and pay their way into heaven. They do this at a mass scale, and people all around Europe seeing this huge interchange of money. And of course, the rich can afford indulgences to get into heaven, but the poor very certainly cannot. Everyone sees this corruption, and people are utterly outraged, in the same way as Chaucer's character was meant to instill outrage in the Canterbury Tales. And not surprisingly, Not unsurprisingly, there is a backlash when Martin Luther in Wittenberg nails 95 Theses to the door of his church in 1517, and this triggers the Protestant Reformation. So pretty quickly between the bank takeover of the church, you have a massive crash of the entire religion. And that really is the beginning of banking with a crash. So you still have this idea persistent, and I think it's really ironic that although Christianity is accelerating now, despite the crash, accelerating banking and finance, and this is an important engine of growth and expansion and innovation from the Renaissance onwards. Despite this, you still have this endemic prejudice against Jewish people, exemplified in all sorts of texts, ongoing violence. But the most famous one of which is in 1605. You have Shakespeare's Merchant of Venice, where the famous character Shylock is seen to try and extract a pound of flesh in order to give a loan with interest to the Merchant of Venice. So this lingering social prejudice goes on. But the reality is that finance and usury, or what has now become legitimized interest, and the payment of interest and the charging of interest, is done by Christians through and through. So it's not long after that, almost a century later, that you have the establishment of the Bank of England. And this follows on from the Bank of Amsterdam, established in 1609, Hamburg, 1619, Sweden, 1656. And all of these have the commonality that they are state or government-sponsored banks. The Bank of England is created by a royal charter. It is initially created in order to finance the government for the 9 Years' War with France. And what it does, like any bank, is it lends money. It can issue negotiable instruments, but these are now what we know today are banknotes, but essentially it's just a check that people can exchange if you are the bearer. And it operates as a clearinghouse for financial transactions. And it is becoming one of the dominant financial institutions by virtue of the Royal Charter. It's bigger than the other small lending houses, and rapidly it becomes intertwined with political power, but not before another big crash. So if we move on a little bit now in the history of banking, we can see that banking is always intertwined with major crashes. So it's not just a sort of metaphorical crash of Christianity when the Medicis take over the papacy, but the first really big one and the world's first stock market crash is when the South Sea Company is created, or after it's created, in 1911. So the South Sea Company is made to trade with a monopoly after a treaty between Britain and Spain in the South Seas, the seas around South America and the Caribbean. And primarily, well, what was that trade? Primarily the most lucrative thing was slavery. So, this is an appalling business, but actually it's not doing very much of the business. It is, however, selling its shares back in Britain. And there's no regulation of companies, there's no regulation of the promoters of companies, so really they can say whatever they want about what the company is doing. Fantastic exotic opportunity to make loads of money in the South Seas, they say on the streets of London, but over in the shores of South America, nothing much is actually being done. And in fact, the Spanish had stopped allowing British ships to enter its waters because of a dispute despite the treaty. But nevertheless, the South Sea Company is responsible in the seas, one of the most dramatic stock market bubbles in history. This is shown in the chart just here, particularly from the end of 1719. The share price starts soaring. And largely this is because people in government and people in the company who are connected are promoting the company as being a fantastic opportunity, whether or not it is actually doing any business. The real turning point, which gives the company a lot of credibility, is that a group of politicians agree to the South Sea Company becoming the banker to the government. So it's set up as a sort of rival to the Bank of England, and sure enough, the South Sea Company takes on the national debt. This lends it a huge amount of credibility, and everybody wants to invest. So you have this enormous speculative bubble seen in the rapid rise of the share price. But then at some point around August 1720, after, I should say, an Act of Parliament is passed to ban other companies being set up without an Act of Parliament. Can't have them created, for instance, through trusts, and this cements the South Sea Company's position even more. In August in 1720, the bubble bursts, and this is essentially because people start to think, how come the South Sea Company isn't actually generating any revenue? How come it's not actually returning any profit? And so confidence collapses in the South Sea Company, and you have this enormous stock market crash. Everybody had invested, and when I say everybody, it includes people like Sir Isaac Newton, all the figures of the establishment. Newton was the head of the Royal Mint, primarily known at the time actually for putting more people to death than anyone else before if they clipped or shaved bits off coins. Newton famously said that he could calculate the motions of the heavenly stars, but not the madness of people. Or, perhaps another metaphor could be, although he didn't really say this, he understand how a pen or an apple dropped to the ground through his theory of gravity, but he didn't understand why on earth the share price had crashed through the floor. But now we know that this is a classic speculative bubble. People become irrational when they're not basing their decisions on good information. And more importantly, from a legal perspective, when the law does not require that good information is disclosed to market participants. And that certainly wasn't the case back then. And it's worth at this point just mentioning another two major crashes, and in fact together these probably can be seen as the biggest market crashes in history, and their consequences were so bad because of their connection to banking. The second famous one is the Wall Street crash of 1929, and in a nutshell, the Wall Street crash was driven by over-speculation in company shares across Wall Street, across the American stock markets. There was so much money to be invested in stock markets because American workers were doing very well through the 1920s. Collective bargaining was slowly inching forward. It ensured that people had more disposable income. America also did very well out of the First World War. Economically, not with the millions of dead like all over the world. So America had done well out of the First World War. Wages were rising. People had money to save, but there was no public pension. There was a cancellation. The Supreme Court, the US Supreme Court, effectively said that Social Security public pensions were unconstitutional. So people flooded their savings into the stock market. And that fueled this enormous boom that led up to the Wall Street crash, because when people realized that the companies in which they invested were massively overvalued, they bought into real estate companies that just owned a patch of swamp with some crocodiles in Florida, or other companies that weren't doing any business. Confidence collapsed, and that led to the Depression. Because once you have a crash, as with the South Sea bubble, where the South Sea Company was doing banking work, it was the banker to the British government. In America, bank stocks also crashed. Many banks went insolvent. And when banks go insolvent, that means that they don't lend out money. And this turns into a depression very quickly, because if banks aren't lending out money to other businesses, then businesses are not going to be able to do as much business. They're going to start firing workers. When workers are fired, they don't have jobs, they don't have any money to spend. If workers don't have any money to spend, then businesses don't have any customers. And if businesses don't have any customers, they're going to need to make cuts, they're going to need to fire workers. And so you get this downward spiral into the Great Depression, which is only really shifted by proactive government, as we're about to see. Then you've got the global financial crisis of 2007, 2008. This crash was caused by banks primarily trading in derivatives of what we call collateralized debt obligations, which are essentially packaged financial products for people paying off their mortgages on homes that they bought. The big problem was in America under the presidency of George W. Bush II. The regulators had stopped having any effective standards for the interest rates, the loan terms which could be charged for people borrowing to buy a home. And so many people were unable to keep up with their mortgage repayments, because their money lenders would say that the mortgage interest rates could be put up to extortionate levels, variable at will. People couldn't pay them, they foreclosed, and so that meant that many people were not paying off the money that had been packaged up into derivative products that were being traded by the billions around Wall Street and around the rest of the world. So what happens in 2007 is that banks suddenly realized, starting with Bear Stearns, Lehman Brothers, that all the billions that they were trading in derivative products on what was known as subprime mortgage debt was close to worthless. And so when banks are left with all these worthless assets, that means that the banks go insolvent. And when one bank goes insolvent, that means other banks start to go insolvent, because the main lenders and borrowers to banks are other banks. So you have this sort of domino effect that threatens to break out with one bank falling after another. The governments of the world have to step in. The US government bails out its banks. The British government nationalizes its banks at a much lower cost. It doesn't bail out the shareholders and creditors to the extent that the Americans do. But nevertheless, you still have the lurch of the world into a severe recession, not nearly as bad as the Great Depression, because we understand how things work a little bit better than in the 1920s and 30s. So banks are intimately intertwined with crashes of the economy. Banking is also intimately intertwined throughout history with political power. And so I just want to give a few examples from Britain, America, and Germany next. So the Bank of England, after the South Sea Company collapsed, was left as the preeminent financial institution. It had wide borrowing powers, and in the Bank Restriction Act of 1797, it did not have any need to convert money that people had deposited with it into gold on demand, or it didn't have any obligation to convert notes that people had into gold on demand. It was increasingly regulated in a number of ways. A really important step was the Savings Bank England Act of 1817, which said that other banks that were increasingly reliant on the Bank of England anyway, but that they had a duty to invest in government bonds or deposit some money with the Bank of England itself. And so that really cements this idea that the Bank of England is the banker to other banks. And so I think it's important to see that what we have now today as central banking all around the world, public institutions, doesn't start off that way. The Bank of England is created with a royal charter, but it's a private bank with shareholders. Yet, because of its dominant financial position, it becomes increasingly regulated. The Bank Charter Act of 1844 says that the Bank of England has the sole right to issue notes and coins, and it keeps reserves that are meant to underpin the gold standard. Go over to America, there was a great deal more suspicion of centralized banking, so much so that the National Bank Act of 1791, created by the now musically famous Alexander Hamilton, was always set to be time limited. So it just had an expiry date. And right up till really the Civil War, there weren't any major federal or state banks that weren't limited by time. Or I should say federal banks that weren't limited by time. So there were a succession of new federal banks, but they expired after a few years. The charters had to be renewed by Congress. And that was essentially because politicians were suspicious of concentrated financial power. The National Banking Act of 1863 during the Civil War enabled federal chartering of state banks, and this was passed over the suspicions and objections of people in southern states, the farming lobby who didn't want banks, but during the Civil War they weren't turning up to Congress, so this was passed. But the really important step was the Federal Reserve Act of 1913, which said all chartered banks had to be members of the Federal Reserve. They had to hold their reserves, or they had to hold reserves for solvency, and they also had the power to buy and sell government bonds. But as we've seen, we have this enormous banking crisis with the Wall Street crash, where bank after bank goes insolvent. And the way that the federal government steps in and solves it, well, really decisively, is only in 1933, when the Great Depression has already hit catastrophic proportions, 25% or close to 25% unemployment in the US. The new Roosevelt government comes in and it stops banking, pauses banking until it has the Banking Act of 1933 passed. This separates commercial banking from investment banking. It sets up a new system of insurance for depositors, so that if a bank goes insolvent, goes bankrupt, then people who've deposited their money are guaranteed by the federal government. That's the Federal Deposit Insurance Corporation, the FDIC, and more widely to deal with the economic crisis that has been left by the collapse of credit. You have the New Deal. So you have the National Industrial Recovery Act. You have huge investment in public works, the Works Progress Administration. All of this in an attempt to try and drive down mass unemployment from 25% back to normal levels, and ideally achieve full employment. Now, over in Germany, the way that full employment was achieved by Hitler was complete destruction of democracy and trade unions, and the government taking control of the state. Hitler, of course, was a psychopath and a rabid anti-Semite. I don't recommend reading it, but if you look at Mein Kampf, you can see every page is laden with anti-Jewish hateful conspiracy theories. In fact, hateful against everyone, but primarily Jewish people, so and communists. So he talks about the lying Marxist press, which aims to break the national backbone of the people in order, for what goal, you might ask, to become the slaves of international finance and its masters, the Jews. So that's just one of many passages that you could pick, which really illustrate how absolutely nuts he was. Hitler builds a political campaign and political strategy based on attacking Jews and attacking finance and the corrupt media, and trying to scapegoat everyone he can. Whatever works, whatever sticks. But it's important to see that Hitler also got massive backing by the banks in Germany for his election campaign. So the Reichsbank, the Dresdner Bank, and the Commerzbank give Hitler over 1 million Deutschmarks for his 1933 election campaign, on his explicit promise to them and the circle of economic friends that he had around him that he'd end democracy from the Weimar Republic. He'd destroy the trade unions and labour rights. And so the the Reichsbank president, Schacht, became Hitler's banker, the central bank during the Nazi period, a sort of seamless transition. Schacht stayed there the whole time. And of course, it only ended through the end of the Second World War. And I think it's perhaps also important to mention that, while other countries, democratic countries, did get full employment eventually, only after a long time, the way that Hitler got full employment was through mass murder, which came at such a disgusting, horrible price, particularly for everybody in Europe. But if you're looking at it from a German perspective, a price that was far too high, with people dead in the bomb shelters, in the scorched cities. Right across Germany. So full employment through mass murder, the attempted enslavement of Europe, was how you got full employment under the Nazis. After the Second World War was over, democratic countries had a different approach. What they wanted to have was, in the words of William Beveridge, full employment in a free society. And the best expression of this in Britain was a white paper called Employment Policy in 1944. And it said that it was possible to get full employment in a free society if you looked at what it was that created unemployment. And essentially it said that unemployment was created because of a lack of investment. You have private investment, which is inherently volatile. You have government investment, public investment, which can be planned. You have international private investment, which is also inherently volatile. And you have international government investment, which can be planned, but a domestic economy like Britain's can't rely on it. And so the strategy behind employment policy for the post-war period was that full employment could be maintained if government planned to do its investment to counteract the fluctuations and the periodic crashes that might take place in private investment and international investment. And so if you could have counter-cyclical government spending, to put it in a Keynesian language, then you could have full employment being maintained. And that was precisely the ideal that worked for 30 years. It was written into the Universal Declaration of Human Rights. The idea of full employment is represented in the words that everyone has the right to work. And the Labour government after 1945 took the Bank of England into public ownership, removing the private shareholders in the Bank of England Act 1946. And full employment was maintained until roughly the mid-70s, when the OPEC crisis took place, the Organisation of Petroleum Exporting Countries. So what they did is they tripled the oil price in 1973, tripled it again in 1975, 1979, which means that all energy prices go up around the world because the economies of the West were reliant on oil and gas. And that's something that we're going to talk about more next time. Okay, so that brings us roughly up to the modern age. Of course, there's lots more that we could say and we will say, but that gets us roughly to where we are now. Every country pretty much has a publicly run or publicly owned central bank, but then the central banks oversee private banks. And perhaps there's public option banks as well, though not yet properly in Britain. And this banking system affects human rights in multiple ways. We don't often think about human rights and banking going together so easily, but they are really very intimately connected. The first and most obvious one is that everyone has the right to peaceful enjoyment of their possessions, so everyone has the right to property, and because banks deal with people's savings, this is one of people's most important forms of property. Ironically, as we're going to see later, when you deposit money in a bank, you don't have a property right in it. You've got a contractual right, a right in debt, a right in the law of obligations, not a right in property. But nevertheless, I think that we can safely say that banking affects the right to property. or the peaceful enjoyment of one's possessions. The second thing, as you'll have picked up by now, is that banking is very important for the right to work and for just and favourable remuneration. In other words, the right of everyone to have full employment on fair wages and working time, which is how William Beveridge defined full employment in his text, Full Employment in a Free Society. And just to recap, the reason why banks affect the levels of employment, whether full employment the levels of employment and whether full employment is achieved, is that the levels of credit overall, lending to business, is going to affect how much businesses are spending, including how many people they are hiring, and how many people are hired. It's obviously the same thing as whether everyone can get a job. And just to add to that, the more people are hired, the fuller the employment is, the closer the unemployment levels are to zero, the more likely that there is to be an upward pressure on wages. By contrast, if you have very high unemployment, then there is going to be a downward pressure on wages because employers can look to a pool of perhaps desperate people searching for a job and pay lower wages as a result. So that's why banking affects the right to work and the right to fair wages. And then thirdly, it affects the right to an adequate standard of living, including for food and clothing and housing. Just as banking affects the right to work, it affects the cost of living. And to just give you one example, if banks are lending a lot of money and there's a lot of economic activity and there's a lot of productive economic activity, then that means there is more food and clothing and housing to go around for everyone. If the economy is generally becoming more productive, then that should lead over a long period of time for prices relative to incomes to go down. But if you have too much economic activity where there is not enough productivity, if you have also, and there is theoretical debate about this, but if you have growing inequality, then that means that there are potentially very strong inflationary pressures. And when inflation rises, of course, the cost of living is going up, food prices are going up relative to incomes. And so the level of credit that banks give overall has an effect on inflation. And that doesn't quite make sense yet. Don't worry, because we're going to unpack that soon. Now, of course, human rights are not fully realised anywhere properly. So what the United Nations has is a set of interim sustainable development goals which are meant to be achieved by 2030. And Sustainable Goal 8 is the most relevant one for banking. It says that we should promote, and this is as a globe, as a human species, we should promote sustained, inclusive and sustainable economic growth, full and productive employment and decent work for all. So, the same sort of headline things as we see in the Universal Declaration. More specifically, 8.1 says that there should be at least 7% GDP growth in the least developed countries. And 7% GDP growth would be very, very high for a country like Britain or Germany or France or Australia. But if you're talking about Tanzania or Nicaragua or Myanmar, then 7% growth is much more likely to expect if you have institutions in place and a banking sector that can promote capital formation and development. Because there is usually so much potential to be gained and growth can be much more rapid. So 7% is the target for the least developed countries around the world. 8.3 sets a goal of promoting decent job creation, entrepreneurship, creativity, innovation, encouraging the formalization and growth of small, micro, medium-sized enterprises, including through access to financial services. So all those things critically seem to depend upon access to financial services. And I should just add, this doesn't only mean private banking. You could have a public banking sector which gives out finance to small and medium enterprises. Decouple growth under 8.4, decouple economic growth from environmental degradation. That's very important. We'll talk about that in weeks to come. Achieve full and productive employment for all men and women in 8.10, strengthen the capacity of domestic financial institutions to encourage and expand access to banking, insurance and financial services to all. So pretty much the same thing again, but note the way that it's framed is in universal terms, that everyone should have access to banking. Excuse me. Okay, so now let's take another quick look at market failures and how they relate to banking. So when we are talking about private banks, when we're talking about private companies in general, we know that there's two major sources of finance. Private banks, like any other private company, will raise equity from shareholders or equity investors, and they'll get loans, debt capital on debt markets, but also very often from other banks. But when we look at the banking sector, we can see that there are many market failures, and related to that, other sources of finance on which banks rely. So just three main market failures, which end up acting as regulatory subsidies. The first is that banks are often a network monopoly. So the creation of credit and the circulation of credit is a network. Banks rely on other banks, particularly big banks, for loans from one another. And if you want to ensure that you can give out as big a loans as possible, then it's ideally the case that you're taking as many savings in as possible. And so what banks do is they operate as this nexus for savings to be channeled out into investment. And the bigger that you are, the more likely it is that you can perform this channeling function more effectively. And so that means that banks have an inherent tendency, through the logic of efficiency, through the logic of network effects, to grow and grow and grow and grow. The bigger you are, the more able, the better it is for you to give credit. And so that's why banks have an inherent tendency to concentrate, and why in pretty much every country you have a central bank that historically emerged out of private banks that became the dominant financial institution, or it was a country that was set up with a banking system that was modelled on what happened, or what we've seen happened with the Bank of England in Britain. Okay, secondly, you have structurally unequal bargaining power and information asymmetries between banks and borrowers. So very simply, a borrower is going to take the terms that is offered from a bank, and other banks like it. There's not going to be that much competition because banks all collectively can refuse to give credit to all borrowers. Borrowers don't have very many other places to go. So borrowers are at a systematically disadvantageous position, and they also lack the information to negotiate better terms that banks will have. Banks can see right across the market. They will understand the risk profile of their customers better than most customers will. And the third thing is that in the banking sector, banks often get away with externalizing the costs of their doing business onto others. So they don't pay for the costs of massive economic crashes or the crash of the Catholic Church. They don't pay for the effects of inflation and unemployment that regularly happen. There are huge moral hazards in banking. And so that's why we see world over that the central bank is in public hands and it's publicly governed. And what central banks do is they conduct monetary policy. They finance other banks. They give credit on cheaper terms to other banks than private citizens can get credit. And they effectively give state aid, therefore, to private banks. They subsidize banks' profit. And so that's the first major source of regulatory or even explicit financial subsidy that private banks get over other businesses. Secondly, private banks benefit from deposit protection. As we mentioned before, with the FDIC in the New Deal, we're going to see, which is common all around the world, in Europe and in the UK certainly, depositors are protected by the state if a bank goes bust. And that means that banks are not, very simply, bearing the risks of their own business. They've got a tacit state guarantee, and that's another regulatory subsidy. And finally, they are effectively insulated, or their creditors are effectively insulated from going insolvent, because government knows through many episodes, much experience, that you can't let a major bank collapse, because that will lead onto a set of consequences that are very bad for the economy. So banks are usually or invariably protected tacitly or explicitly from going insolvent. And so this is another source of finance for banks. And that's why they don't operate like normal enterprises in a free market. They're heavily regulated, and there's a mixture of public ownership. And that's what we have to start looking at in more detail now, starting with their finance. So now we're going to continue with the finance of banking and want to look at three main things. Firstly, the monetary policies that the central bank uses to change interest rates and ideally influence levels of inflation or unemployment. Secondly, the fact that banks have a significant source of finance from their network monopoly position and the way that they can take advantage of that. And thirdly, the protection that banks have for depositors and in insolvency, again from the state, which gives them another tacit source of finance, another regulatory subsidy on top of the sort of overt forms of debt, equity, financing, or an explicit state aid. So first of all, we want to look at central banks and monetary policy. And what we're going to do is look at the governance of central banks a bit first. Usually we would deal with this later, but because central banks are so central to the way that private banks operate, it makes sense to look at how they're structured before we look at the effects that they have through their monetary policy powers on the financing of other banks. So the starting point is that government guarantees the solvency of the central bank. That's the case with the Bank of England. It's the case with the Federal Reserve in America. And governments can guarantee the solvency of banks in a way that no other company has, or few other companies have access to guarantees. Government is different, the central bank is different, because governments have the power to raise tax. Private citizens cannot tax, but governments, through the force of law, can do so. Okay, so the banker to the government is the Bank of England in the UK. That is explicit in statute and has been explicit under the Exchequer and Audit Departments Act of 1866, although, as we've seen, de facto the Bank of England became the banker to the government long before. Several pieces of legislation regulate the Bank of England, but one of the primary ones, at least for now, that we're concerned with is the Bank of England Act 1998. And under sections 1 to 2A, His Majesty appoints up to 14 directors of the Bank of England, and there aren't really any requirements about who these directors should be. It's up to the discretion of the executive. The Chancellor of the Exchequer, who piloted the Bank of England and championed the Bank of England Act 1998, Gordon Brown, wanted and told Parliament that he wanted to have a range of independent business views represented, representatives from across the whole of the UK. That there should be representatives of industry, of labour, but this actually isn't anywhere in the law. It became practice, but it's not anywhere formally in the law. Under Schedule 1, there are more detailed governance rules. There's a governor of the Bank of England appointed for 8 years. They could only be removed if they're found to be unfit, unstable, or bankrupt, unsurprisingly, by the board of the Bank of England. But otherwise, it's very hard to remove them. And that is meant to be the guarantee, or at least one of the major planks of the so-called independence of the Bank of England from government. And I suppose it's worth just saying a tiny bit about why Bank of England independence is meant to be important, why central banking independence is meant to be important, because as they are the banker to the government, if the government had total political control over what the central bank did, how much money in aggregate it lent out to other banks, or the terms on which it lent out, then it becomes very easy to use the central bank for political purposes. And in particular, in the run-up to election, manufacture a big boom in credit, which stimulates spending, stimulates jobs, growth right before an election, makes everything look good. But then if that credit boom is unsustainable, there can be a recession afterwards when productivity doesn't rise in a sustainable way to match the expansion of credit. And so in order to ensure that there isn't what Gordon Brown called a boom and a bust cycle, or boom-bust economics, the Bank of England's independence was meant to keep decisions that the Bank of England made about monetary policy away from government and away from political influence. Although in practice, as you can tell from the appointments process, the Bank of England is politically appointed entirely. But once that happens, they remain more or less at arm's length, even though political pressure can be intense. So if we look at the sort of chain of money from the government down to citizens, we can see that His Majesty's Treasury is ultimately guaranteeing the solvency of the Bank of England. The Bank of England does monetary policies we're about to get into, which benefits all the private banks, and the big four are like HSBC, Lloyds, Barclays, Royal Bank of Scotland, although that's part of the NatWest Group now since its collapse or near collapse in the global financial crisis. And then these big banks lend money out to account holders like you and me, people who want to buy homes, and businesses. And so that's how money flows through the economy. But ultimately, it's backed by the ability of the state to tax. Okay, so it's worth comparing the Bank of England to the European Central Bank and the Federal Reserve in America, because these are the two of the biggest financial institutions in the world. They're greatly influential as well, and so it's useful to see what's going on over the pond and across the channel. So starting with the European Central Bank, under the Treaty on the Functioning of the European Union, Article 131, member states' banks have a duty to act compatibly with the European Central Bank. So what happened with the Eurozone's unification in the early 2000s is that central banks of member states gave up their ability to conduct independent monetary policy. They gave those powers to the European Central Bank. Gordon Brown in Britain never wanted Britain to enter the euro, and so that never happened for Britain, although that might have made Brexit an awful lot harder. Under Article 283, the European Council appoints a 6-person executive board for the European Central Bank after they consult with the European Parliament and the existing European Central Bank Governing Council. There's also a statute of the European Central Bank, and this says that a broader Governing Council is the European Central Bank executive plus governors of the European Central Banks from the member states. They can only be removed for gross misconduct, pretty similar, although defined slightly differently, to the Bank of England. And then over in America, you've got the Federal Reserve, the Fed, and this was created by the Federal Reserve Act 1913, and under Section 241, it's the President that appoints the Board of Governors on the advice and the consent, or rather just the consent of the Senate. And this is slightly different to the other the ECB and the Bank of England, because explicitly in law is duty on the president to consider fair representation of financial interests, agriculture, industry, commercial interest groups, and there are 12 constituent banks. Although it should be emphasised that there's no actual appointment rights or voting rights for any of these groups in particular. So the central banks are really top-down controlled, and that probably means that there is a narrower range of interests and views being represented in the conduct of monetary policy. It's supposed to be seen as something that is left to the experts, but what that means is inevitably that there's a great deal of groupthink, particularly when it comes to which economic theories are applied to the conduct of monetary policy. And as we're about to see, there's a heavy slant towards really discredited and evidence-free theories of monetarism from Milton Friedman and people like him. So that's broadly speaking how central banks are governed. So now let's take a look at some sort of basic theories that guide, or at least traditionally guided, central banking in what we call macroeconomics. And this was a discipline really in economics invented from the Great Depression, and an important book by John Maynard Keynes called The General Theory of Employment, Interest and Money. Before then, you didn't have sort of macroeconomics separate from microeconomics. There was just one economics, or there was political economy before that. But Keynes really through this book emphasized that aggregate decisions about managing the economy as a whole is very different to how a household should be managed. The running of an economy as a whole by government is completely different to individual households, particularly because of the nature of tax, ultimately backing what the state can do, and the overall influence that central banks have on the credit supply and the ability to create credit and therefore drive investment and growth, which households cannot do. So as a starting point in economic theory, we take the position that an economy is stable and there's an equilibrium overall in the economy if all the things that are being produced, all the things that are being supplied are being bought, and supply matches demand. That's where we can say that there's a sort of macroeconomic equilibrium. But, argued Keynes, there can be a lower propensity for people to consume depending on how wealth and income is distributed throughout the economy. And Keynes didn't say this very loudly, but it is there very clearly in particularly, I think it's chapter 22 of the General Theory. If inequality grows, that means that there will be a lower propensity of people to consume their income. Very simply because if I'm very rich, I don't need to eat any more food. There's only so many oranges and apples and bananas and pieces of bread that I can eat. If I'm rich, I tend to save my income. I don't consume it. And that means that there is less money flowing around the economy. It could also be the case, and this was the time that Keynes was writing in, a fall in effective aggregate demand. You could have an economic crash. And as a result of an economic crash, you could have businesses beginning to fire workers. Workers, therefore, don't have as much income. They spend less, they consume less. And that means that businesses have fewer customers. They need to fire workers, and so on in the sort of downward spiral that we've mentioned already into a depression. So if you have a fall in total demand in an economy, for instance, through a crash, this can lead to, as well as lower propensity to consume, a lower velocity of money, said Keynes, circulating through the economy. And, without the jargon, that's just less economic activity, less buying, less spending, and therefore less income for businesses. So how do you get out of this situation? Keynes argued that it was inherently fanciful to rely on private actors who were suffering, or part of the suffering, of the loss of credit to somehow magically and spontaneously stimulate demand, aggregate demand rising again. What you needed is for government to step in and spend its way out of the crisis by investing with borrowing from the private sector or raising money itself, promising to guarantee extra spending itself as government, because governments can do that for the future, handing out cheaper credit to stimulate demand. Governments need to act because markets will not correct a Great Depression. And that is exactly the theory that was being applied by progressive governments. In fact, even before Keynes wrote the general theory, he was really reflecting what was already happening politically, being driven by lawmakers. And the Federal Reserve Chief, Marion Stoddard Eccles in Beckoning Frontiers, written in 1951, says very, very similar things, drawing on his time as the Federal Reserve chair. Eccles, however, was much more emphatic than we see at Keynes, or much more open with this idea that one of the chief drivers of a depression, one of the chief drivers of a lower propensity to consume, is the growth in inequality. He thought that that was one of the chief factors that exacerbated the depression after the Wall Street crash, because inequality was growing in 1920s America so much. Now, I think it's important to see that in the conduct of monetary policy and what central banks do, as we're about to look into in more detail, there are distributional conflicts. And because there's these distributional conflicts, we see different theories from different authors who have different positions in, which social actors they favour. So if you've got a monetary policy that favours more employment, that is better for workers and it's worse for employers. If you have fiscal spending, which is spread evenly around the country, that's good for everyone around the country, or you can target it at regions, or you can target it at cities. Monetary policy can't do that. If you have one interest rate, just to take one example, one interest rate for everything across the country, then that means there is the same interest rate and the same borrowing rate for depressed regions as well as booming cities, or vice versa. So that means that the distributional impact of monetary policy choices is profound, and that's what drives a lot of the theoretical disagreement. Okay, so we've got certain goals set down in the law of what monetary policy should be doing. And so let's look at Britain, the European Union, and the United States. So the Bank of England at 1998, sections 11 and 19, lay out the objectives of monetary policy. First, to maintain price stability, and subject to that, to support the economic policy of His Majesty's government, including growth and employment. What is price stability, you may ask? I suppose most people would think it means the opposite of inflation, but it's left to the Treasury to interpret what price stability means. And one of the big problems with that is statute leaves open the question about whether it's just consumer prices, whether it includes house prices, whether it includes inequality growing. All these sorts of things could be defined in or out of the definition of price stability, and therefore what the Bank of England is looking at when it's conducting monetary policy. Monetary policy decisions are made by the Monetary Policy Committee of the Bank of England, which has 13 members. Under Section 19, the government can give directions to the Bank of England, but only in extreme economic circumstances. So that's another guarantee of the Bank of England's supposed independence. The Bank of England has a practice of meeting every 6 weeks to determine what its monetary policy should be doing. At the moment, in December 2025, there's going to be a meeting on the 18th of December, and it's likely that the rates of interest are going to be cut from their current level of 4%, maybe down to 3.75, maybe down to 3.5%. And of course, this has a huge impact on people who've got mortgages, who are paying variable rates, and the level of mortgages will have a knock-on effect on landlords if they've got mortgages, so it affects renters as well and the level of rents. So these are really big questions that matter for people's basic costs of living. And so then we've got the Treaty on the Functioning of the European Union. Article 282 says that the ECB's primary objective shall be to maintain price stability and without prejudice to support, without prejudice to the main objective, support the general economic policies in the Union. And what do these include? Well, we see in the Treaty on the European Union, Article 3.3, that the European Union aims for full employment, social progress, and improvement of the quality of the environment. And then we've got the Federal Reserve over in America, and it's much more progressive. It highlights in fact, a range of factors, and it doesn't prioritize price stability. We're going to see why that matters in a second. So it aims for the long-run growth of monetary and credit aggregates, increase in production, maximum employment, stable prices, so there's price stability, alongside and on an equal level to maximum employment, and moderate long-term interest rates. So the important thing to note at this point is where the concepts of employment rank. Does it rank above price stability, next to price stability, or below price stability? And we can see that the Bank of England generally ranks it below, so does the European Central Bank. The Fed puts it alongside. There's no mention in any of these mandates of the effect that monetary policy can have on inequality. The cost of living is not explicit. It is embedded in this idea of price stability, but that's a very different thing, overall price stability, to the ordinary living costs that people face, including their rent, their mortgages, food, and so forth. And what is completely absent is any mention of some of the main drivers of inflation, particularly fossil fuels. And I mentioned fossil fuels, and we'll talk about this when we do oil and gas much more extensively, because two of the biggest periods of inflation in modern history, during the 1970s and early 1980s, and in 2022, 2023, were driven by the raising of prices of oil and gas, largely by dictator states in OPEC or Russia. Okay, so if you want to control inflation, if you want price stability, then that means you should be getting rid of fossil fuels and replacing it with clean energy, which is not subject to volatile swings in prices, often at the behest of dictators. But none of that is included in the statutory mandates of the banks, or at least not yet. Okay, now how does the Bank of England, the ECB, and the Fed conduct monetary policy? Now, the rules are slightly different for each of these. We're just going to focus on the Bank of England. First of all, the Bank of England may, if necessary in the public interest, issue directions to any banker for the purpose of securing that effect is given to the directions. And so this is in the Bank of England Act 1946, Section 4.3, but it's never actually been used. So, for instance, the Bank of England could tell retail banks, we want you to fix your interest rates at a certain level. But it hasn't done that yet. It's often perceived that there might be distortions in the market if direct instructions were issued, but nothing has been done yet. Second of all, you've got reserve requirements. So the Bank of England can require that the reserves held by other banks in the Bank of England's accounts are raised or lowered. And the effect of that is important on the level of lending, because if I'm a private bank and I'm required to hold more in reserves, and then that means I've got less capital to lend out to other banks. So that's really important, and the reverse, of course, is true. And we also see similar rules structuring what banks should do with their reserves from the Basel III Accords and reflected in the European Union Capital Requirements Regulation. Third thing is we've got the base rate, and this is the most familiar one to most people. So the Bank of England base rate is the headline rate of interest at which the Bank of England charges other banks. It has a target of 2% inflation, so it should put interest rates up or down to achieve its inflation target, and that is really important for the way that the Bank of England conducts its monetary policy. But the main thing is open market operations. And what central banks do here is that they buy and sell vast quantities of securities. And we see an example of that operating in a case called Gauweiler and Deutsche Bundestag, which was a claim about the open market transactions conducted by the European Central Bank, or open market operations. It was claimed that these were violating the Treaty on the Functioning of the European Union, Article 123. This importantly banned the European Central Bank from engaging in economic policy as opposed to monetary policy. And by economic policy, the treaties are taken to mean lending money to member states. This is like a no bailout clause in the treaties for member states, because it was thought that it would be bad for rich member states like Germany to subsidize poor member states, or member states that were not keeping their sovereign accounts in good order. Okay, so you can't do economic policy under the treaties. There was a challenge when the European Central Bank bought up government debt on the secondary markets, and instead of buying them government debt directly from governments, it would buy government debt from other people who had bought from governments. And the reason that it was doing this was to ensure that governments stayed solvent during the Eurozone crisis. The Court of Justice held that it was lawful, but the reasoning is frankly not very good. Really, they were making a policy decision, entirely ignoring the purpose behind the treaties, but that was incredibly important to save the Eurozone from collapse, particularly as hedge funds all around the world were speculating on Greece going bust and the stability of the euro being threatened. Okay, so now let's say a little bit about the connection between employment and inflation, because as we've seen in the central bank mandates, there are goals for full employment and there are also goals for price stability, the opposite of inflation. Over time, we can see that employment levels and inflation levels have no necessary connection with one another. This is a chart showing UK unemployment from 1881 right up until I think it's 2020, and that's in the purple line. And in the blue dotted line, which is plotted on the other on the y-axis as well, you see the level of inflation. And what we can see is that in times that are good, you generally have fuller employment and lower inflation, namely from 1945 up until the beginning of the 70s, and also from the mid-90s up until the global financial crisis. Inflation low, and employment consistently coming down. And of course, there's lots more to say about this. But the big problems where you see that huge inflation spike from 1973 and again 1979 is with the OPEC oil crisis, where the Organization of Petroleum Exporting Countries triples the price of oil and then triples it again a few years later. That drives inflation, and then because of a series of responses by government, unemployment is put through the roof as well. So there's no necessary connection between employment going down and inflation going up. On the contrary, when things are good, things tend to be good. When things are bad, everything tends to get bad. Now, there certainly is a connection between fuller employment and rising wages. And this was charted by Phillips in a famous paper in 1958. What this chart shows is from the year I think it's end of the 19th century, 1861 up until 1913. And the second chart is from 1948 up until 1957, and it shows that when unemployment is close to zero, the rate of change in wages is high and positive. And that is just logical. The lower unemployment is, the less competition there is for jobs among workers, and that means that they're in a position to demand higher wages. On the other hand, if you have higher unemployment, then that means employers they've got more bargaining power, and they can pay workers less because workers are desperate for jobs. But then what happened is that a couple of economic theorists, Milton Friedman in particular, drawing on from some speculative writing by Friedrich von Hayek, argued that there was also a trade-off between inflation as a whole, not just rising wages, and employment. And they argued that there was a natural rate of unemployment, and that if government tried to use fiscal or monetary policy to get to full employment, then that would lead to soaring or runaway inflation. And by about a decade ago, it was widely accepted among economists. The problem is that there is no evidential foundation whatsoever for this supposed connection between inflation and unemployment. So these two charts show the UK from 1949 until 2015, and the US as well. It's just a very simple scatter plot. It shows the years where there is a particular unemployment rate and the years where there's a particular inflation rate. And if there was any connection between the two things, then you expect to see some kind of line or some kind of curve showing a positive or a negative correlation. In fact, what you see is a completely random relationship between unemployment and inflation, which tells you that Friedman's theory of a trade-off between unemployment and inflation was completely mad, completely baseless, completely evidence-free, motivated by Friedman's own politics, which is that he didn't like big government and he didn't like proactive government, more particularly or more precisely to rescue economies from the depths of economic crisis, particularly because proactive government policy might benefit workers and might reduce profits from employers, and that was very much the corner that he was fighting for. And the reason why there's no necessary connection between unemployment and inflation is that if production is expanding, wages can rise without any inflation at all, without any increase in general prices, because there's going to be more production, so there's no greater competition for scarce resources. Everybody is just going to be better off. And that matters so much for monetary policy because what central bankers are often doing when they are prioritizing price stability is that they have in their heads theories like those of Milton Friedman, that there's a natural rate of unemployment, and tackling inflation, getting price stability, means taking action that will clamp down on wages. And so if those theories are followed, it can be incredibly damaging. Manufacturing unemployment to create inflation is something that central bankers have done before, and some of them, maybe not overtly, are still doing it. You still hear it being said every now and then. But the theory is wrong. There was no evidence for it. And that's why proper monetary policy should be able to take into account the objectives of achieving full employment and price stability, more importantly, a stable cost of living for everyone, without any necessary trade-off between the two. Let's look at another source of finance now for banks. And this is their position of network power or network monopoly and the accompanying power that comes with it. So the Bank of England, as we've seen, became the dominant bank in Britain and slowly was regulated as it became more and more important to the economy. Most countries have banks as well that are very concentrated outside the central bank. And this creates a problem that when you have very few banks with a lot of lending power, they are too big to fail. If you let any one of them go down, that will have catastrophic consequences across the economy. Although we should add that this idea that banks might get too big to fail neglects the fact that you probably don't want small banks to fail either. It would be a very good thing if no banks failed at all. And so prudential regulation, supervision, ensuring that the securities markets are properly regulated, and ensuring that banks have good governance practices is just good for everyone, big banks and small banks alike. But because of their highly concentrated network monopoly position, banks' capital concentrates, and they have more power vis-a-vis customers. They can put up prices, they can restrict the supply of capital, and this can lead to higher unemployment, inflation, or even a crash. And this is because of their market power. This is something that subsidizes banks' businesses in a way that other banks would not be able to take advantage, or other businesses rather, would not be able to take advantage of. And so we can just look at pretty much any country, but here's the UK. In the FTSE 100, HSBC, Lloyds, Royal Bank of Scotland, part of the NatWest Group now, and Barclays are the top four banks. And whether you look at the current account market, mortgage market, or small business lending, they have a huge share. The four biggest banks have much more than a majority of market share across the economy. And the third major source of finance is the tacit government guarantees that come from deposit and insolvency protection. So customer deposits are guaranteed by the Financial Conduct Authority up to £85,000. We've got these rules in the Financial Services and Markets Act 2000. So if a bank goes bust, all your deposits are safe because the government guarantees them. If you're lucky enough to have £86,000 or more, then you're going to potentially lose the last £1,000, but the rest will be safe. And that is very important as a subsidy for the solvency of banks. Banks themselves don't guarantee anything to customers. All customers have is a contractual debt. So when you put your money in a bank, Foley and Hill tells us, as I mentioned before, that all you've got is an obligation. You don't have any security interest. You don't have any property right. You get no priority in insolvency. You rank as an unsecured creditor. And that is one of the main reasons why we need a government guarantee by the Financial Conduct Authority and related rules. Then there's also a government guarantee for the solvency of banks, at least to the extent allowed by the Banking Act 2009. So this says that in cases of banks going insolvent, the Secretary of State should pursue one of three options, and ideally the first, not the third, the second if not the first. So the first one is that if a bank goes insolvent, they should try to sell to a new private purchaser. If you can't do that, try and start a subsidiary company to take over the bank's bad assets and establish a bridge bank. But if you can't do that because the situation is too bad, then you should take the bank into temporary public ownership. And in this option, all the shareholders will lose their money. That's just natural when a company goes bust. But what is tacitly going on is that we're not letting the bank go into an insolvency procedure. This is the insolvency procedure. And that means that the bank's creditors won't lose a lot of money. There could be more complications than that. There could be a lot of negotiation about credit, but the basic, the default rule is that the bank's solvency, at least vis-a-vis creditors, is being guaranteed by the state. And that's an extraordinary privilege that banks have that other enterprises do not. Okay, so now let's look at how banks are governed. So under the governance of banks, and we've already seen the governance of central banks, so now we're mainly focusing on private banks. and we're going to look internationally as well a little bit. But what we want to do is consider four main things. First of all, the basic governance model of banks. Second of all, the licensing oversight that is exercised by the regulators. Thirdly, we'll take a look at the IMF and the World Bank. And fourthly, we'll say a little bit about public options and mutual banks, although there are very few of those in the UK today. So first of all, the basic model of bank governance is set by the Companies Act and the UK Corporate Governance Code. We've seen how the Bank of England has a different system. The Court of Directors is appointed by the Prime Minister or the Chancellor, usually in negotiation or consultation with one another, and removable only for a limited set of reasons. So that's strong public oversight, to say the least, because the government is appointing them. But with private banks, it's completely different. Directors are typically appointed by their predecessors, and they can appoint their successors. The board appoints future boards, subject only to majority vote of the members who can remove them. And we see these rules in the UK Corporate Governance Code and the Model Articles and the Companies Act section 168. We're saying a tiny bit more about nomination and remuneration committees. Remember, from general company law, directors on the board usually select their own successors and nomination committees. This is the UK Corporate Governance Code 2024 section 317. Majority has to be independent, but when we look at the definition of independence in section 210, it simply means that the directors have to have not been an employee for 5 years or more. That they have to have no significant business relationships for 3 years at least. They have to not be taking fees or some other significant business relationship, family relationship, no other close links, for instance, through a family member or business partners, not have significant shareholdings, and not have been a member of the board for over 9 years. But absent all of that stuff, you can still be supposedly independent on the board, even though nobody is appointing you except for the board itself. So the word independence is really a bit of a sham because the so-called independent directors are appointed by the very board which they are meant to be overseeing. They are not accountable, therefore, in law there's no requirement for them to be accountable to any particular stakeholder, in particular not the staff, not the service users of the enterprise, not the investors in the enterprise. And then we've got the Model Articles, paragraph 23, which, as you recall, says that directors by default set their own pay. Directors shall be entitled to such remuneration as the directors shall determine. And the UK Corporate Governance Code bears this out in section 532. It says that there must be a remuneration committee made up of independent non-executives. But again, the board is essentially paying other members on the board. No accountability to any other stakeholders. So that is the general model of private governance of banks in the UK. In European Union member states, it's slightly different. There has to be, for instance, worker representatives on the boards of most EU countries, most large companies, and for banks in particular, when there is a member state law requiring worker representation, they have to be included on the remuneration committee. But that's something that the UK has not done yet. Then we've got really a different set of rules for banking to other enterprises or other general enterprises in that they have to be licensed and they are overseen by the regulators. So the Financial Services and Markets Act sections 1 to 2C set out a host of rules, but they say that there's these two main bodies, the Financial Conduct Authority and the Prudential Regulation Authority, and the sort of Grundnorm, the golden rule, a basic rule, is that there's a general prohibition on doing a regulated activity unless you've got a license. What's a regulated activity? Well, it includes accepting deposits from the public, so that's the core idea of banking, unless you're licensed by the Prudential Regulation Authority, and that's for carrying activities on in the UK. Very similar rules under the Credit Institutions Directive 2013 for the European Union. There have to be in each member state provisions on authorization of banks. prudential rules, so they're conducted, banking business is conducted properly. And if you get your license in one EU member state, that means that you get a passport to operate in every other EU member state. So it can be very important. Then there's the Financial Services Act, Banking Reform Act of 2013, which requires that core activities of banks, and this is really a response to the global financial crisis, including accepting deposits, are ring-fenced from other activities, notably investment banking. So this was seen as being like a Glass-Steagall Act rule for the UK in response to the global financial crisis, where the basic idea is if the investment banking wing has been doing stupid things, investing in derivatives, speculating in a less than sensible way, then this should not affect the retail banking business. The two sides should be ring-fenced. And then there's prudential oversight. So the Bank of England and the Prudential Regulation Authority are the main overseers for banks' prudential rules. And we see an example of this in the case Three Rivers and the Governor of Bank of England. And this is where the House of Lords held that a claim by the depositors of the Bank of Credit and Commerce International would not be struck out and could go to trial. Although it didn't have to be it didn't go to a full hearing, full case, another decision because it was settled. The Bank of England here was accused of misfeasance by failing to properly oversee BCCI's operations. It knew that there were very severe things going wrong. The claim of the depositors was that they should have acted earlier and faster to prevent the collapse of BCCI. So this case establishes that yes, the Bank of England does have a duty in public office to exercise its regulatory powers in a sensible way, and failure to do so can sound in an action for misfeasance. Then we've got global financial institutions, and particularly the World Bank and the International Monetary Fund. And these play a major role in lending money to governments and also helping governments when they're in distress. But we don't have time to go into this, the International Monetary Fund in particular is notorious for worsening many crises because when it lends money, it often attaches conditions, and the conditions can be worse than the crisis that the country is in. For instance, deregulate and privatize your economies as a condition for getting loans. So the World Bank has a board of governors. This is voted in by United Nations member states, and there are share votes that are weighted according to the member states' investment, and this determines the votes that different countries have for who sits on the World Bank. It's not one country, one vote. It's weighted according to member state investments. The World Bank has basic purposes of promoting foreign investment, an equilibrium balance of payments between countries in a peacetime economy. And then there's the International Monetary Fund. It has an executive, and appointments to it are made by, again, a vote among United Nations member states, which is weighted this time by what we call special drawing rights, and that's essentially money that's being put into the IMF. Its purposes are to foster international monetary cooperation, balance growth of international trade, high levels of employment and real income, note that it doesn't say full employment, and development of productive resources, avoiding competitive exchange depreciation. Finally, we should say a little bit about public option banks, although there is not really a proper one in the UK. Although there have been before. So the big four banks are HSBC, Lloyds, NatWest, and Barclays. But what we don't have is a public option competitor, as many countries do. We did have under the Post Office Act 1969. This enabled the Post Office to provide a banking service, what we call gyro money transfers, and the 1976 Act extended the powers of the Post Office Bank to set up current accounts. There also used to be quite a lot of mutual banks which were owned by the customers, the depositors, but in the 1980s many of these demutualized, turned into normal banks. The only real big mutual bank is Nationwide Building Society. National Gyro Bank, like many of the post office's functions, was privatised. It became a limited company in 1989, spun off from the post office, and then it was sold off to the private sector by the Thatcher government to Alliance and Leicester in 1990, which then got taken over by the Spanish bank Santander in 2013. There is still banking at the post office. There's post office money established in 2004 under the new Labour government, but this is just a brand name for banking services which are actually provided by the Bank of England under the post office brand. So there's not an independent bank run by the post office anymore. Britain also has an investment bank, but it's very, very limited. So, for lending to businesses, there is the British Business Bank, established in 2014, with pretty meagre capital. That's being expanded significantly at the latest budget. They're going to have £25.6 billion in lending capacity from next year. But if we compare this to other countries, Britain is pretty far behind. In Germany, you have a network of what are called Sparkassen. In every German state, there's a different Sparkasse, and these are publicly owned banks which hold about 31 to 40% of the market share in Germany. And very simply, they offer very, very good rates, and they drive competition amongst the private sector in a way that is a form of discipline that British banks just do not have. And then you've also got a German investment bank called the Kreditanstalt für Wiederaufbau, which means the credit institution for reconstruction. And you can just see from the numbers that its scale is far more vast than anything in Britain. In 2025, it had 545 billion euros in assets compared to the 25.6 billion pounds in lending capacity that the British Investment Bank has. So it's about 20 times bigger in Germany. And of course, that is potentially a big boost for German business that a country like Britain does not have. Okay, so the next thing we want to look at is customer rights. There's four things to address here. First of all, the nature of property or contract in a bank account, which we've already covered, but let's just say it again. Second, the rules on deposit protection. Third, on consumer protection. And fourth, a right that's existed for about a decade to a bank account with basic features. So, as we've said, you don't have property in your bank account. That's the effect of Foley and Hill, confirmed again. I mean, that was a long time ago, 1848. They had another chance, the courts, in 1986, in a case called Vincent and Trustee Savings Bank's Central Board, where the claim was, very simply, that people who saved in Trustee Savings Bank had a beneficial interest under a trust in the money in their bank account. And the court held that even though trustee was in the name, there were no equitable property rights at all. And as we said, what this has as a consequence what this means as a consequence is that people don't have any priority in insolvency. They've got no property right, either legal or equitable, and that means that they are unsecured creditors if a bank goes bust. There have been proposals, the Deposit Current Accounts Bill, for instance, to create the option of having a proprietary savings account, perhaps for more fees, but it hasn't gone anywhere. And there was a similar movement in Switzerland to try and make sure that all money in bank accounts had to be backed up by hard currency. There was a referendum in 2018, but it failed. So you don't have property in your bank account, and that's pretty much the same in every country. Therefore, banks all around the world benefit from the same regulatory subsidy. All banks have, almost all around the world, operate in systems where the government guarantees deposits. So as we mentioned, Financial Services and Markets Act guarantees up to £85,000 in deposits. In the EU, it's €100,000, and all this is modelled on the Federal Deposit Insurance Corporation in the United States, which has done the same thing since the beginning of the end of the Great Depression. Then we've got a host of consumer protection rules which are particularly relevant for banking. So the Consumer Rights Act 2015 says that all contract terms have to be I should say, all non-core, non-price contract terms have to be made in good faith, and there has to be a significant balance with no surprising terms. Otherwise, the terms can be held by a court to be unfair, and there are powers of the Competition and Markets Authority to regulate the use of unfair terms. But importantly, these requirements of good faith and balance only kick in if the terms are not part of the price that is payable, and they're not what is known as a core term of the contract. And we see an example of this in Office of Fair Trading and Abbey National, where there was a claim by the Office of Fair Trading against Abbey National and a group of other big banks over the bank's use of unplanned overdraft fees. And this very simply was where, for example, you go to a cash machine, you get out 10 quid or 20 quid, and unfortunately this puts you into overdraft because you don't have any money left. The bank puts you into negative digits and charges you overdraft fees, even though if you had been asked, if you've been told by the bank that you were going into overdraft, you wouldn't take the money out. And so this was a widespread practice. Many people racked up hundreds or even thousands of pounds in unplanned overdraft fees, and this was often the very people who could not afford to pay them. And that constituted about 30% of the profits of banks on these kinds of bank accounts. The Supreme Court rejected that unplanned overdraft fees could be reviewed on the basis of whether they were made in good faith or there was significant balance, because it said the unplanned overdraft fees were part of the price of an account, and so they were just not subject to review, which is a bit strange because most people would think that the price of a bank account is that the bank gets to take your money and invest it and take a cut of the interest, usually all of it, when they invest your money. But that's not what the Supreme Court seemed to think. It seemed to think that unplanned overdraft fees, even though it's not the main price, was still part of the main price of a contract for banking services. So the Supreme Court wasn't going to do anything to help bank depositors. The Consumer Credit Act of 1974 also creates a right against extortionate interest rates being charged and unfair credit relationships. So if you think back to medieval times and the bans on usury, this is the closest that British law has to a limitation on usury, but it's set at a very high level. The interest rate has to be extortionate before it is unlawful. Finally, there is a right to an account with basic features that has to be free. And this is really important to ensure that everybody has universal access to banking. And even with these rules, it's not the case that everybody has access to a bank account, but it is getting pretty close. So the Payment Account Regulations 2015 requires that the major banks provide an account with basic features. And this means that you have to be able to open and close an account, deposit money, withdraw money, make direct debits, and make card transactions and online transactions. Everybody has to have these facilities without fees. So that is, a really important step in bringing universal service to everyone. And what it doesn't do is it doesn't give people the right to access loans on favourable interest rates. It comes from the Payment Accounts Directive 2014 from the EU that says pretty much the same thing. Okay, so finally, looking back over the landscape of banking, we can pick out some options for reform if we want to make the banking sector live up to international human rights standards, or if we want to make British banking on par with international standards that we see in prosperous member states that generally tend to be wealthy and have a higher degree of capital formation. First, if we look at the Bank of England, There's an easy gain to be made by amending monetary policy objectives to include full employment, real wage growth, and stable prices, and the imperative of ending coal and oil and gas all on an equal par, rather than prioritising a fight against inflation, which, as I mentioned, is often premised on the idea that there's some natural rate of unemployment, which really doesn't exist, and there's a trade-off between full employment and inflation. Secondly, prudential regulation powers of the Bank of England in supervising the banks could be used to ensure that banks divest fossil fuels, because the Bank of England regulates the lending practices of private banks, and private banks are still investing in new oil and gas fields around the world. And of course, that is not only bad for price stability, because fossil fuels are inherently volatile, but it is threatening the future of planet Earth and human society. So better get to zero fossil fuels and clean energy as quick as possible, and prudential regulation could drive that much faster. Thirdly, you could look at the Bank of England's board and ensure that there's more stakeholder representation for workers, pension trustees, different regions around England that are affected in different ways by monetary policy. You could put those requirements explicitly into Schedule 1 of the Bank of England Act 1998. And then secondly, outside of the central bank, on other banks, we could look at the governance, ownership and wealth issues that these banks are connected to. So firstly, look at the board of different private banks and ensure that they are at least 1/3 elected by staff. You could have an option for the minister to raise it to a half, in the same way as the pension legislation works on member-nominated trustees, and set a requirement for account holders to have some voice, as they used to in mutual banks before they were demutualised. Give at least a sixth of the board to representatives of account holders. And you could have analogous rules for stakeholder representation in investment banks, including the British Investment Bank. And then ensuring that the post office has a bank account free at the point of use, like the basic account provisions, is very important, but also have a public option bank that really operates not just with basic account features, but like a proper bank, doing mortgage lending, doing personal loans, doing business loans. And this is the surest way that you could have the private banks competing on a fair basis, to make sure that there is a public option to drive the competition in the most efficient manner possible. And finally, you could give more capital to the British Business Bank in order to boost investment and crowd private finance alongside public finance for all the things that need investing in the future economy, whether it's data centres, clean technology, clean energy, great investment in transport. All of this will be boosted by having more public investment through an entity like the British Investment Bank.